Summit.
Hello and welcome to the 7th edition of UTI Mutual Fund and CNBC TV18 present the Financial Advisor Forums 2015-16, and we're coming to you with our third forum from the City of Joy, Kolkata.
In 2016, the Financial Advisor Forums travelled to 4 top Indian cities and have covered the cities of Delhi and Bengaluru in an attempt to reach out to independent financial advisors and discuss the growing concerns of adoption of technology, scaling up of their business, and how they can help investors move away from safer assets that have guaranteed but low returns and invest in equities and mutual funds for better returns.
Welcome to the third Financial Advisor Forum 2015-16. We're coming to you from the city of Kolkata, and we have a power-packed panel here for you today. Joining me on the panel are Prasenjit Mukherjee, CEO Plexus Management Services; Naresh Pachisya, Managing Director SKP Securities; Suraj Keli, Group President Sales and Marketing UTI Asset Management Company; and Satish Krishnamurthy, Senior VP and Head Affluent Business Axis Bank. As I kick off the panel, Suraj, I want to come to you first. We hear a lot of talk about India having a demographic dividend, and the youth is really important. They're out there, they're earning money. Very few are saving that money or investing that money. How should IFAs maybe tweak their what they have, their message, so that they can connect with the youth?
I think that's a great point to start, and I always believe that for any business to be successful, the macro is fairly important. So if you look at India's macro, whether we look at the GDP growth, whether you look at the savings rate in the country, especially the household savings, you look at investments in financial assets vis-a-vis physical assets. So on any of these parameters, even longevity for that matter, I think this business is a very, very exciting business. But having said that, I think it's also equally important, to really think in terms of solutions. You can organize your business as an IFA on product lines. So for example, you say, okay, I'm selling mutual funds, I'm selling insurance, I'm selling tax-free bonds. Or otherwise you use the language of solutions. For example, you say, okay, I'm in the wealth creation business, I'm in the risk management business, so I do a risk practice, I do a wealth generation practice, I do a tax planning practice. So once you move on to the solution framework, it becomes very easy for you to approach any of your customers. So in this case, if you're trying to meet some younger people, you say that, look, at this age, you obviously are in a capability of saving a lot more. But somebody needs to go and highlight to them the importance of starting early and saving for the long term. And if you take a solutions approach, I think you'll do a great job.
Prasenjit, there's another thing that we associate with the youth is technology. There are two sides of the coin. There are some feel that technology is disrupting our business, and there are some who take it in stride, saying that this technology is helping us with our business. What's your take on technology?
Technology is a given. In today's world, technology is something that we have to live with throughout. But the technology that we have, even though it is disruptive in terms of providing a business angle, it shouldn't be disruptive in the relationship frontier. So as long as we use technology to broaden and deepen the relationship ambit with the end audience, I think technology is welcome. But what is generally happening, or what can happen, is people tend to, especially at the IFA level, people tend to substitute the value of relationship one-on-one with the technological parameter. If both of them tend to coexist, then there is a whole commonality running through the argument which tends to be greater than the sum of its parts. But if one is substituted for the other, then we have a doomsday situation.
Naresh, you are based in Calcutta, so I want to talk to you a little about the local area. There have been years earlier where chit funds were really big in Calcutta, and unfortunately people lost a lot of money. What is the sense now, and again I don't mean just Calcutta but this full eastern belt of the country, what is the sense on these chit funds? Are people still going out for chit funds, or what is the customer mindset change that you're seeing?
I think there is a great awareness now that about chit funds and how they have really completely eroded investors' money. so that the greed for that higher profit which made them go to or attracted by the chit funds, that greed I'm sure would have been addressed by now, and this is the right time perhaps for all the independent financial advisors to be able to convince such investors towards proper planned financial planning based investing, so that they can use those scarce resources, their savings, to for fulfilling their life's financial goals. And that's, I think, it's a very good opportunity that people have. Earlier what was happening was, when you used to go showing that you will get such modest return, 12%, 9%, 15%, in hinterlands of Eastern India, people would come back and say, oh come on, you can't give me the return that I'm getting from this chit fund and that chit fund. So that resistance will not be there anymore.
Satish, your background is with handling the HNIs. How is dealing with HNI different from dealing with a retail customer?
Let me start with the commonality. Whether it is an HNI or whether it is a entry-level retail customer who's just started his earnings journey, I think he needs to start by trusting his advisor, right? And that trust is earned by delivering real value. That value comes by financial returns fundamentally. And now if you were to just step back for a minute to see how do you go about scripting that journey for the customer, right? The essence of it is that there has to be clarity with the advisor, sitting across the table with the customer and agreeing on the financial goal. Is that goal realistic? Is that achievable within the time frame which has been laid out, right? Having got that away, you look at the risk-return trade-offs, right, and make the customer well and truly aware of the risks involved in that journey, right? I think also the clear nuances of managing the HNI set of clients is that they have today information at their fingertips, right? They have apps, right? They have Bloomberg screens in front of them. So the idea is that the intelligence that you deliver through your research backbone becomes a very, very critical piece of the value that you create, right? Apart from research, it's also about the speed and simplicity with which you are able to execute the transactions for your clients, right? And if you are available to that customer whenever he needs you, and you're able to anticipate his needs ahead of his curve, right? You have a winning formula.
It's time for a short break, but on the other side, this Power Pack discussion will continue. We'll be right back.
To deliver trust, you need to run a business of the highest integrity. And as a financial advisor, one expects you to be supremely knowledgeable about your subject matter. So irrespective of the asset class, and the asset class can range from let's say debt to equity to structured products, the entire range of products, you need to be a subject matter authority. And you need to therefore act as a guide to the client and deliver strong financial value. And to me, that will be the single biggest, I think, value that a financial advisor will add to a client's life.
Welcome back. You're watching the Financial Advisor Forum 2015-16, and we're coming to you from the city of Kolkata. Naresh, I'll come to you on the trust bit. So building trust. Now, you have, like I said, decades of experience in the industry. How is it to build that trust and for the IFA to stand firm at a time when the markets will always be volatile, but the IFA has to stand firm and to communicate to the customer that you are not in it for 1 month, you're in it for 10 years or whatever your goal is. How do you manage that?
I think it's very simple. I think we need to tell the customers that even as an advisor, we can go wrong on our study of the markets, our analysis of the markets. You need to be very clear with the customer that you cannot lord over the markets, but what you can lord over is your dedication, your sincerity towards the customer's cause. And on a sustainable basis, if you keep on doing those things the right way and make the customer feel that you are actually working for their cause, I'm sure you would earn a trust and respect of the customer. To an extent, those customers will ignore quite a few lapses also if they were to happen in terms of your advisory or reading of the markets going wrong. So I think over a period of time, it is very much doable.
Okay, students, I want to come to you from a little bit more of a macro perspective. So recently I read about the, Mr. UK Sinha with SEBI talking about wanting to push mutual funds through e-commerce sites. Again, two sides of the coin. There'll be some part of people who will say, oh no, it's going to disrupt IFA business, where there'll be others that will say it'll expand the reach of mutual funds, which will help. There will be a certain portion going down e-commerce, but there will be a certain portion that will come to the IFAs on that. So what are your thoughts on that?
Well, the way I think about it is that the primary concern, which I think the regulator is trying to address is lower penetration.
Yes.
So because penetration levels are low in India, so one of the thoughts is that, can we expand the number of channels through which we deliver this product in the market? And e-commerce is one such, proposition in that space. So typically, my personal views on that, have been that e-commerce, typically if you're buying on a Flipkart or Snapdeal, you buy a product, you make the payment, and it's all over.
Yeah.
But in mutual funds, in fact, when you buy the product, your association really starts at that point in time. And I'm not very sure whether, a e-commerce platform is really one of those engines which can be really levered to just buy. So obviously, there are investors who are savvy, who understand, and if convenience comes through an e-commerce platform, perhaps it may work. But the reality is that I do believe this journey of wealth creation, and especially the audience that is there, on that space, many youth. Of course, there are older people also now joining the bandwagon. But those individuals still have not experienced the volatility of those markets. And eventually, if they were to buy simpler products through e-commerce platforms, probably that may work out. The fact is, if the investor goes and makes a mistake, actually then they turn to the advisor for help. So actually, it may in turn help the advisory business build up as you go forward.
Prasenjit, when we were talking earlier, you and me were discussing this point about the need to maybe make the process for a customer to get to purchase a mutual fund easier, how IFAs can make their operations seamless. What are your thoughts on that?
Today, doing a mutual fund for a distributor or an advisor as well as a customer is a very cumbersome process. If it is a first-time investor, then it is actually intimidating. The sheer number of FATCA, granted the fact that it's a globally accepted treaty, but how does it affect a guy who is at 28 years and he is on the verge of leaving India for US, UK, wherever, and you make him sign 5 forms detailing what all account he's got? This guy is scared.
Yeah.
He just doesn't know, and we are looking at some of these customers, we are looking at some of these investors, and their ready refrain is, "Nahi boss, let me not put all so much details, let me stay with a fund, let me stay with a fixed deposit, or let the money be." I think the most important thing that we have to do is get the KYC streamlined between all the registrars that we have. Second is, let there be a uniform structure for every form. If somebody has given a personal detail to one fund house, it should be equivalent to that particular detail available to every fund house, because largely we have 2 registrars in the country. If these 2 together can't do the job for 90% of the business, then what seamlessness are we talking about? The point is the seamlessness which can be done at the back end, even at the cost of 2 paise extra for investors, should be done so that the joy of investing is there. I suppose before the technology comes in, let's have the back end, which is far more easily manipulated with the construct of the fund houses.
Satish, for this quarter ending, for the year ending, when people are very hell-bent on wanting to do tax saving, do you know what the behavioral change that you want to do tax planning? Great, but start it in April rather than March, and kind of don't do investments just to save tax. What's your experience?
You've pretty much laid out the reason why consumers in India need financial advisors. Because they are not led by a strong, intelligent person with financial acumen. They wake up when the newspapers are suddenly talking about this is the last opportunity to do your tax planning, and then they are scrambling. And when they do that, you end up making mistakes. I think this behavior is the root cause of a consumer's poor financial wealth building journey. And I think people need to understand that just as they are working very hard, whether they are running their own self-employed firms, they are part of companies, or they are salaried, their money needs to work equally hard for them to get wealthy, right? So to make that construct a reality, they need to start early. And I think the only way this can happen is communication. And that communication needs to happen throughout the year.
There's lots more to come from the Kolkata edition of the Financial Advisor Forums 2015-16, but it's time for a short break. Don't go anywhere. We'll be right back.
If they educate themselves properly, and with that education try and get into the customers, try to understand the financial anatomy of the customer and his family members and their needs and their risk profile, and accordingly advise them according to their goals, is try and set that asset allocation and whatever their protection needs are, take care of all these basics, and I think they would have won the hearts and minds of their customer families, and which will go a long way in having a very, very sustainable relationship, and then they can scale up with the number of customers that they have.
Welcome back to the Kolkata edition of the Financial Advisor Forums 2015-16, and joining me on the panel are 4 eminent members of the financial advisory community. Suraj, according to the AMFI website, it says equity-oriented schemes are now 31.7% of industry assets, up from 30.6% in January 2015. So slow and steady progress. But how can this be expedited?
Just think about it. You meet a young man and tell that person that, why don't you save some money for your future? Let's generate some wealth.
Yeah.
And equity is the best tool for generating that wealth. So let's assume you have got 10 lakhs of rupees and this person is 18 years old, so got 40 years to retire. Now it's very simple mathematics that if you were to double your money every 5 years, you'll have 8 time periods, and 2 raised to 8 is 256. So that 10 lakhs becomes 25 crores. Now you ask the same person that now that you got this 25 crores, what do you think you're going to do with this money? Right? And the quick answer is, I'm going to keep it in a bank deposit. So the moral of the story is that people don't want to take risk with the money, right? So when you're not having enough money, then equity is a great tool. But when you generate enough wealth, then you're saying, okay, why do I need to run this faster? So I think 31% is a good number to begin with. It's not a bad number to, worry about.
Sure.
Second is market levels will change these percentages. So if tomorrow markets run up another 50%, this 31 will be 45%. So don't read into those numbers too much. What is important is that build a good asset allocation where you're comfortable. You need to ensure you meet your requirements for the day.
On that note, it's time to head to the audience for some quick questions. This is A. Bharat, ARN number 26274. Naresh, he says, in the present situation, whether focus should be on equity or debt.
Market circumstances should not be actually guiding investments alone, It has to be in the context of the investor's risk profile and his financial goals, the time horizon available to complete that goal. Wealth creation over a long-term period is the purpose of investing. Then equity funds is certainly the way to go. India is doing well in terms of its growth, and certainly the GDP growth will translate into corporate profits also moving up, and so would be the equity markets. So you are likely to get good returns. If capital preservation or regular income over medium to long term is your goal, in that case, of course, debt funds make sense, and particularly more so in when we are seeing interest rates likely to come down over the next couple of years. You will get returns. Debt funds will be giving you very, very smart returns.
This one's from Amit Rathi. Firstly, if you want to take this, he says financial planning is necessary, but still we have to sell the fact that it is necessary. Should be our efforts to make them understand again, or we should move on to another client?
Fantastic question, and this is something that we fight with on a practically daily basis. The fact of the matter is that you cannot afford to move away from one customer to another. The deeper you go with one customer, not only do you make more money from that same customer, but remember, a referral is the easiest and the most sure shot way to go to grow the business. So instead of moving from client to client, focus on the client enough so that all these clients become your referrals in the market. And coming down to the base point, financial planning is supposed to be a continuous affair, and that is a very difficult thing to sell, and there is no way that we can let go of the customer just because one particular financial planning exercise is done with. It's going to be next year, another salary hike, another child, another school, so it's a continuous process.
By Rishikesh Swine, Satish, I think you could be able to help out with this one. He says, since the customer's banker has more information about his or her cash flow, they are in an advantageous position to explore the opportunities first, which may or may not be exactly in the client's interest.
See, in a fair market, people are competing. So the banker's advantage is that he's got the most integrated platform. He's got not only the inflow, he's also got information on the outflow. Right? And therefore, more often than not, they tend to be having a great positioning advantage to be able to solve client information needs, right? Reserve Bank of India is coming up with a platform solution whereby they have sought for, applicants for getting integrated information on all the holdings of clients. So with these kind of new innovations around the corner, I think that advantage is going to be constantly challenged.
Well, that's all the time we have this week on the Financial Advisor Forums 2015-16, presented by UTI Mutual Fund and CNBC TV 18. But next time we head to our final forum at the financial capital of the country, Mumbai. Until then, from the entire team, many thanks for watching.
The one true fact which I have, which my experience tells me is most important is make a client for life. Which means focus on the issues that the client wants and not really focus on the issue that you want the client to want. I suppose that makes a huge difference, and it's so transparent that a client realizes and understands that his best interests are being safeguarded. So he takes an interest back in the workings of the IFA. That's how both of them grow.
Focus, ideate, innovate, enable.